Let's welcome on board Sandip Sabharwal. By the way, the India-Pakistan fever, we're taking a little bit of a break from that. The match is tomorrow. Let's handle what the market is up to because the GIFT Nifty is indicating quite a bit of a step back for us, about almost 145 points lower right now. Sandip Sabharwal, hi, morning. I guess it's going to be IT, which is going to be the first thing that we're going to look out for. And it's quite, a little bit shocking that Infi for two consecutive quarters on the row has had to cut their guidance and doesn't seem like they still have visibility on when things will improve for them.
Yeah, they don't. So I think many of the analysts are getting excited about the order bookings which these companies are doing, but they need to realize that many of these orders are 3 to 7 year kind of projects, and their start date in many times is also not fixed. Uh, so I think that's what has many analysts excited, and they are predicting that from next year growth will revive. Actually, if you look at the macroeconomic picture, the US Fed and central banks all around the world, I think India is very well placed that way relatively, are actually trying to slow the economic growth in order to control inflation in a sustainable manner. So, trying to forecast that next year things will improve is a fallacious view in any case. So, I think that's what is the issue. This is something which I've been pointing out for several months that the growth visibility for IT companies is going to deteriorate. Discretionary spending is going to be cut even further, and it's some quarters away when actually we'll see the revival come through. Many of these companies have still been able to show some margin upticks because they have deferred wage hikes, uh, variable pays, etc. Which I think HCL and Infosys both announced that they'll be doing it this quarter. So I think that might be a further hit on their margin. So outlook doesn't look exciting at all.
Yeah, it doesn't look exciting at all. And, Sandeep, like in one of your tweets, you were mentioning that both Infosys, Reliance Industries, TCS, there's some of the, stocks which are most largely held by funds and along with HDFC Bank, of course. And given the kind of stark underperformance in these stocks, one wonders as to what's going to happen and when, funds will sit up and take notice and make that adjustment.
So I think many of the funds will never make that adjustment, so they'll just wait out for things to change. And I think that gives the opportunity actually for people to outperform because most of the larger funds, both on the large cap side and flexi cap etc. side, have Infosys, HDFC Bank, ICICI Bank, uh, TCS, all these stocks as their top holdings, and so that actually also creates a question mark on the overall index performance. So I think just the index, because these stocks are such heavy overweights, that the probability that the index will do anything great also then reduces, and we have to look for stocks beyond the index and beyond the sort of comfort zone. And on the other hand, if you look at the economic picture, which data which came out yesterday, inflation fell much more than expected. IIP growth was much better than expected. So I think it's time to focus more on the domestic focused companies.
Sandeep, that's been the very interesting trend, right? While demat accounts have also risen, the SIP inflows have risen, some of these market focused companies are doing very well. I mean, be it AMCs, be it, platforms like Angel One, etc.
Yeah, so I think the performance of some of these companies actually has been very robust and also surprising to some extent because the competitive intensity is quite significant. There are zero brokerage, etc. companies, but I think some of these companies have done exceptionally well. AMCs went through a phase where for a few years their profits hardly grew when despite the assets growing and because the cost increases were happening and the fee reductions mandated by the regulatory were playing on their overall profitability. But I think now they could be entering into a phase where the next few years could be 15-20% kind of earning growth. So they could become steady, stable return companies. And that's also resulted in some of these AMCs getting re-rated over the last few months.
Sandeep, I must admit that I've always been an SBI bull because I'm fascinated with what they've done, not only in terms of managing their branch network, also in terms of digital. Do you think one should get slightly myopic and look at NIMs and pressures on retail spreads and get bearish on the stock, or SBI is something which will continue to surprise us?
So, NIM compression has been known. It is something which is out in the open, and everyone knows that there is going to be NIM compression. Now, the extent of NIM compression is what we should be worried about, if at all. Now, in my view, among the PSU banks, SBI will have the lowest NIM compression given their huge CASA book, and which continues to grow, unlike many of the other PSU banks where that's more under pressure. So I think uh, I'm not very sure about all these logics which have been given. It's not, so I don't own SBI at this stage because I prefer ICICI or Axis Bank. But I think all the logics which have been given seem to be very flawed.
Sandeep, one would argue and say that SBI, the banking space is due for its comeback. Numbers are not going to be bad. The stocks, in a sense, have underperformed and consolidated.
Yeah, because the only thing I will be watching out for will be if there is any uptick in the entire NPA cycle and whether NPA start picking up. Because a lot of the profit growth of the last 2 years, one, there was NIM expansion, of course. The second part was because the write-offs were reducing so much and then there were recoveries. So I think all that was contributing to the profit growth. Now, a large part of that is behind us. Now, if NPAs remain stable, then I think we'll see many of these banks come back and revive. But wherever we see small upticks in NPAs, I think their investors will become concerned. So I think that will be the critical thing to watch over this quarter and the following quarters.
And Sandeep, wanted to get in your thoughts on the entire metals basket, given that we have seen, firmed global prices as well. That has been quite a, benefit for most of these companies. What's the view within this sector?
So I think, Avan, these are more trading kind of bets. So there'll be short-term moves in these stocks because as prices move up from bottomed out levels, etc. But looking at the global macroeconomic picture and especially China outlook, I don't see a runaway rally happening in metals and as such in metal stocks. So I think people have to play it this way. There will be trading rallies. If you make decent money, just exit them.
And let's also get in views then, Sandeep, as to what you're penciling in when it comes to HDFC Bank. Come Monday, it'll be the first time that the merged entity will be declaring its numbers. And the expectation is that we could see a profit of about 14,800 odd crores. We'll be watching for a contraction this time around in the margins. The asset quality could be flat versus the merged entity numbers that had been disclosed. What is it that you think the street will closely monitor?
I think these are the two things which you talked of. One is what is the NIM compression going to be, and whether it's going to accelerate going forward or stabilize. And secondly, what's the NPA figure that gets reported and the trends in that. I think these are the two critical figures for the merged HDFC entity. So any improvement in these parameters will lead to the stock doing well. Any deterioration could lead to this prolonged underperformance, which has been in for the last 2 3 years, continue for some more time.
Meantime, just mapping out the kind of move that we've seen from last week and what we've seen from those recent highs as well. You've got the realty index, in fact, from those 4th October lows that has gained about 8.7%. And clearly it's been the cynosure of all eyes, the kind of move that we've seen. And it seems to be synchronized, Sandeep, within the entire real estate space. What's looking good here?
Yeah, it's been an extraordinary number of numbers. The numbers reported on a pre-sale, whatever pre-booking basis for real estate companies across the board have been actually very surprising to me. Also, the kind of strength it still sustains after interest rates have also moved up. So I think for people who want to take a lower risk, they need to stick with the larger players like something like a DLF, Godrej Properties, etc. And for people willing to take more risk, I think there are a large number of listed real estate companies. But historically, we've seen these companies get into trouble every time there's a downtake. So I think we need to be very careful about that.
What about, before we let you go, what would be your top 3 mid-cap recommendations?
That's a tough one. Three
But
recommendations.
okay, give me one at least.
So I think among the stocks, I think are on the value zone on the consumer side. I would think something like a Voltas and Aditya Birla Retail. I think these two are the ones which we are actually accumulating on every day because I think the downside is limited. Near term upside, I'm not very sure, but I think over the next 1.5 year, we should be able to get 25-30% out of these.
All right, thanks so much then, Sandeep, for joining in and sharing with us your outlook on the markets.